Using the official numbers, we can confirm that we are in a state that is worse than the 1930s. This goes for many countries around the world. It happened suddenly and it has impacted most industries. The GDP is heading further and further into the floor, central banks are desperately intervening, and stimulus has been like a fire hose out of control. Liquidity cannot fix any issue. It's already written in stone. You came here for the truth, so let me unveil that for you. Today we're going to look at the absolute facts. I want to show you what's happening with the GDP and give you some numbers around that. I want to also look at the S&P 500 and what makes it up. This is important to note, of course, because we have seen major changes leading into 2020 and where we are at today. This goes for the economy, this goes for the markets, this goes for all the stimulus that we've been seeing as well. I've got a lot to cover. Let's begin. The Federal Reserve Atlanta has their latest estimate for the GDP now sitting at 42.8%. The GDP Now model estimate for real GDP growth in the second quarter of 2020 is minus 42.8% on May 15th. This is shocking. We can see the different statistics that have been adding up here, looking at the different indicators. This happens to be just one of them. It is an estimate. We'll see what the official numbers pull up, but to see it being worse than what we had during the 1930s is truly something to behold. On the right hand side in the bottom, you could see the different pieces of the chart here. Essentially, we're looking at the blue chip consensus as well as the GDP Now estimate, and we get the same thing from others as I'll show you today, but we're looking at essentially a minus 30 to a minus 40% on the GDP. Now, this is just one thing that I look at. GDP or the estimates are only as good as the data going into them, and we know that those are molded and manipulated, and we can't say this is the real economy because there are so many other ways to look at it. But using the GDP in a historic sense, as well as measuring GDP against other things, it gives us some useful information. But we need to know that it's not the be all end all. It is just one of many, many indicators that are out there. Here we have the New York Fed and the Nowcast model. You could see that their GDP quote unquote growth is at minus 31. There's a chart that corresponds to that. You could see what has happened. Is this the bottom or is this similar to what we've seen before? Just a stall before it drops even further. I'm not really sure where it's going to end up. You can see the components that are here. We're being told that this is a V-shaped recovery, and most respectable investors, analysts, business people, they're all saying the V-shaped recovery is a fantasy, but there are still some out there who are willing to spread the lies, and that is unfortunate. So Jerome Powell talking about shrinkage. That's right, shrinkage. Powell says the GDP could shrink more than 30%, but he doesn't see another depression. Fed Chairman Jerome Powell told 60 Minutes that the US GDP shrinkage could be in the 20s or 30s. But you don't have to worry because everything is going to be okay. I quote, an even better place than where it was before. This is what we always have to hear. They're going to be out there cheerleading. They're going to be out there promoting how fantastic it is. So buy your stocks now. Don't worry, we got your back. But I'm not really sure that's something that people should trust. In the long run, and even in the medium term, you wouldn't want to bet against the American economy. The American economy will recover. There he is, waving his flag, making sure that everything is a-okay as far as he's able to do. They usually put these people out there at the right times. They schedule these interviews with the mainstream media not well in advance. This is an emergency. They're doing this to make sure that investors are calm, that everything stays put. They know how to do this. They've done this so many times before. People don't see those patterns, but essentially that's what this is all about. In the bottom paragraph, he's essentially talking about how in the second quarter, everything's going to be totally fine, but it might take a couple years to get back to where we were previously. But don't worry, it's going to come soon. And then he confuses the message because he's going back and forth from propaganda to actual data, and it confuses the whole thing. But that's what a central banker is constantly doing. Here he talks about how the response by central banks and governments have been so fantastic. That's why it's not going to be like the 1930s because we really reacted. Well, of course, we know this isn't true because if you look at what the Federal Reserve and other central banks around the world were doing during the 1920s, they didn't call it the Roaring 20s for no reason. They were so active in making the easy monetary policies known because from 1913 and on, we knew that funny money was going to be the name of the game. But let's leave that out because, of course, nobody wants to hear the truth. So in the long run, I would say that the US economy will recover. We'll get back to the place we were in February. We'll get back to an even better place than that. I'm highly confident of that, and it won't take that long to get there. It's just silly when I read all this stuff. I mean, I'm trying to make a joke of it, but really it's embarrassing because people do believe what these people say. I've said it once, I'll say it again. Do not believe the suits and ties on television. People are swindled all the time, and unfortunately, it's just getting worse. I want to switch gears here. We're going to talk about what's going on with the S&P 500 and what makes it up. You got to understand we're talking about an index and think of it just like your portfolio. It's not going to always stay the same, or at least it shouldn't. This is constantly in flux. Take a look at what's going on 20 years ago in that index. Look at it 100 years ago in that index. You're seeing companies that didn't even exist 20 years ago are now the biggest companies today. Look back 100 years, many of those companies don't even exist anymore. So things do change, and right now we're seeing some changes going on with the S&P 500. What we're seeing right now is shaping up as a flashpoint in stocks as overseers wrestle with pushing the eject button on wounded companies. It's an urgent issue for the people who run the benchmarks of the S&P 500, where dozens of companies are at risk of deletion, at least theoretically, after shares plunged in March. I think this could impact what we're seeing with the ETFs, of course, the actual stocks themselves, but ETFs is one that people need to pay attention to because more of the investment is heading into these, and I don't think a lot of people understand how they work. They are not an index necessarily, they are mimicking the index, and if you can't figure that out, you got to know what's going on behind the scenes of these ETFs. It's just like when you buy oil ETFs, you're not buying oil, you're not buying the commodity, you're buying something which is a derivative of it. There's a very big difference. The S&P committee is going to have to decide how long they want to wait before ditching these damaged companies. The S&P 500 may be the world's most followed passive index, but the 2020 crisis and its aftermath is going to force its constructors into some very active choices. They refer to the remarkable recovery in the S&P 500, which a rebound that the strength is largely ascribable to its weighting in technology and healthcare stocks. Less appreciated is the impact of 4 dozen company ejections over the last 3 years, deletions that centered on retail, industrial, and energy companies, which have struggled the most here in 2020. Here's the chart that corresponds to that. Outcasts, companies cut from the S&P 500 in recent years fell more in the sell-off. You can see the basket of stocks removed from the S&P 500 and see how badly they've performed. Minus 56%. And while some stocks you have seen rise up higher than they've ever been, in this case here, it's certainly not the same thing, that's for sure. Tech takeover. Tech makes up more of the S&P 500 than at any time other than the dot-com era. This has been growing over the years, definitely, and it isn't too far off. During the dot-com boom, it was probably around 34% or so, and now today it's sitting at approximately 27%. We know specifically that the top 5 stocks in here make up the most of the gains that we've been seeing. I've been tracking that as well. Many people don't care because they're invested in those 4 or 5 stocks, FANG stocks, tech stocks. But whenever you have this concentration, it always creates a problem on the way down. They don't believe there's going to be a down, but of course, we just saw this happen multiple times over the last few years. Significant drops, weakness in certain areas, and lessons never get learned. CEOs are cutting millions of jobs, yet keep their lofty bonuses. Bosses are taking pay cuts, but are CEOs really sharing the pain when salaries make up just a tiny fraction of the total pay? They explained it in here. They give you so many examples if you want to check it out. This is a good article to see if you're interested in this topic. But essentially, when you have your compensation, you as an individual, everything might be just the salary. That's what you make. They give you your paycheck, and that's all. Many of these CEOs, these big executives, the salary might be a small piece of the pie. They might have bonuses in here. They might have stocks, options, whatever it might be. That's encompassing really a larger percentage. I believe they said in here that the salary is often only about 10%. I believe they're trying to avoid what happened in 2008 and looking like the bad guy. So they're going out and saying, well, you know what? I'm going to take a cut in my salary. Nobody really knows what else happens that can make front page news. So they put that out there. I brought this up on my blog or community section of my channel, and I'm just talking about Warren Buffett, and I want to know your opinion here, because this article, Out of Market Watch, it's an opinion article, dud stock picks, bad industry bets, vast underperformance, it's the end of the Warren Buffett era. And what I want to ask you, if you want to comment below, is does Warren Buffett know what he's doing? He's sitting on, I believe the number was $137 billion of cash, waiting on the sidelines, saying he doesn't see anything attractive. Many people have said, that's it, Buffett's done with. But he's not the only one saying this. He's not selling off all his stocks. That's not what he's doing. He's just waiting for an opportunity. He's still buying stocks. He's selling some stocks, but he's got enough cash to be buying major corporations and instead just waiting. Is he right? Is he wrong? What do you think? That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. Thank you very much for that. If you want to see me on Instagram and Twitter, I'm doing videos on there every single day. Check me out at The Money GPS. Do you want to learn how to sell stuff online, make money, side income, or maybe even replace your full-time job? It's up to you. There's a lot of info out there. Most of it is garbage. I created a free e-course that not enough people take advantage of, but check it out, theamazongps.com. If you want to understand the foundational principles of finance, of money, of currency, the creation of it, the central banks, interest rates, everything in between, and have it explained to you so simply that anybody can pick it up and absorb it, these two books will have everything you need. Check out the link in the description if you want the audiobook, themoneygps.com. Okay, this video here is so important, but have you seen it? If not, definitely watch it. Watch it at 2x speed if you have to. Click on it. I will see you there.